Okay, welcome back to part 6 of this chapter 18. We are looking at the end of a concluding part of the cash budget. Okay, we were looking at the second quarter. We saw that the net cash flow was negative, negative 176 million roughly. Okay, and then the starting balance was the previous total cash balance. So here we assume, because this starting cash balance is from here, okay, we assume that this surplus or deficit in the given quarter is not addressed yet. Okay, that's the assumption here. So the total cash balance here will be the starting cash balance here. Likewise, the total cash balance here will be the starting cash balance here. Likewise, the total cash balance here will be the starting cash balance here. So that's how this works. Therefore, here the net cash flow is negative, plus the starting cash balance, which is higher. You have a positive cash balance, but it's still lower than the minimum cash balance. Therefore, you need to borrow. So there is a deficit in this quarter, second quarter, about 37.5 million. Now, in the third quarter, you have a net cash flow, which is this total collections minus total disbursements, which is 25.8 million roughly. Okay, and you have the starting cash balance from here, 12.5 million, so a total cash balance of 38.3 million. Still, it is short of this 50 million cash balance minimum that you want. Therefore, you have a deficit. This minus this, you have negative 11.67 million roughly. Alright, so you know that there is a deficit of this much in the second quarter, and if this deficit is not addressed in this quarter, you will have another deficit of 11.6 million in the third quarter. And the fourth quarter, you have a net cash flow of 122.5 million, and the starting cash balance, assuming that the deficits are not addressed here, you have a total cash balance of 38.3. Then when you add, you have 160.8 million, which is way higher than the minimum cash balance, and therefore you have a surplus of 10.8 million. This minus this, you get the surplus. That is how you get these values, surplus or deficit of cash. Now the utility of this is that it tells you when and how much you will have deficit or surplus cash in which quarter. So this will allow the company to plan ahead. For example, if there is a negative 37.5 million in quarter 2, this means that the company will have to borrow and make arrangements to borrow about 38 million or 37.5 million in the second quarter. Okay, likewise, if this is not addressed, then in the third quarter it will have about 12 million that it needs. Okay, and so on. Note that there is a surplus here and a surplus here, but there is a deficit in between. And even if these deficits are not addressed, okay, you will get back a surplus at the end of quarter 4. But then it may be too late. You still have to make these payments, right? Therefore, the company needs to make these arrangements earlier, right? And it can know that by having a surplus at the end, the company will know that these deficits can be paid by using the surplus in quarter 4. Right, but this is the tentative work in progress cash budget. Okay, because we have not addressed this surplus or deficit here, and we'll do that later once we have looked at the various types of borrowing or short-term sources of financing. So we'll continue with by going back to our slides. Right, we come back to the slides here. So we have finished this cash budget. Let's skip this. Okay, we have done all this. We have covered all this. Okay, we have come to this. The cumulative surplus or deficit here. Now this is rounded to the nearest million. So what I've shown you earlier in this clip using Excel, which is similar to this, but then in Excel the numbers are more detailed, to the nearest cent rather than rounded to the million, as done here. But it's the same answer, right? Let's move on. Now we move on to a next topic. Part 4 of this chapter looks at the various sources of short-term borrowing. Now the various sources can be divided into two. One is the unsecured, the other is secured. Secured sources here and unsecured sources. Secured here means there is collateral. Collateral or assets that are pledged to back up the loan. Here unsecured loans, there are no collateral. Collateral here means assets that are used to pledge. Pledged assets against the payment of loan. Let's say the payment is not made, then the lender can seize the collateral, the pledged asset, and then liquidate or sell the assets to recover the payment. That is what we mean by collateral. So unsecured loans means there are no collateral. These are loans that are given out to borrowers who are well known. So lenders will know the borrower and therefore there is no need for collateral. Or the borrower are well known or low risk. Therefore there is no need for collateral. There are various types of unsecured loans. One is called the line of credit. This is offered by a bank. The line of credit is a term used in the US. We have similar arrangements in Malaysia. We call this overdraft. Banks offer you overdraft. Now this is an agreement to borrow up to a certain limit. Now there are committed versus non-committed lines of credit. This line of credit can be given divided into two portions. One is committed, the other one is non-committed. Now committed means the borrower must use up to a minimum. But non-committed means there is no obligation, but the borrower can use up to a maximum. Maximum is stated in non-committed, but committed, whether the borrower uses or not, the borrower must use to a minimum. Even if they don't use, they must pay interest on the minimum loan balance, approved loan. So that is called committed. So generally non-committed would be more convenient for the borrower, but the interest rate might be higher for non-committed types of loan, line of credit. Then there is another type which is called revolving credit arrangement. This is the agreement for 2 or more years. So it's basically a line of credit, but there is an agreement in the loan agreement. There is an agreement or clause saying that this loan can be renewed at certain conditions, with certain conditions. So this makes it easier for the company to renew the loan. Let's say there is a need to extend the loan beyond a certain term, so revolving credit arrangements may be useful rather than one line of credit. Then another type of unsecured loan will be letter of credit. This will be issued by a bank that agrees to pay the exporter for the importer. This is issued by the importer's bank on behalf of the importer. And the bank will agree to pay the exporter if certain conditions are met. And this letter of credit is an important instrument. This can be used. It is actually a document for payment rather than for credit. But this can also be used as a document to obtain borrowing. And this document is discussed in greater detail in international finance. Not so much in this course, but then this is a very important instrument in international trade and international finance. Alright, these are the various types of unsecured loans. And then secured loans, meaning there must be a collateral, there must be an asset that backs the loan. That meaning if the loan is not paid by the borrower, not repaid by the borrower, then this collateral or the pledged asset will be seized by the lender to recover the payment. So there are various types of collateral. The first one is accounts receivable financing. So accounts receivable financing means accounts receivable will become the collateral for the loan. Now there are two types of accounts receivable financing. One is called assigning, the other one is factoring. Assigning here means the accounts receivable is held as security. Collateral is also means security by the creditor, meaning by the lender. But the receivables collection will be done by the company. So the receivables will become the property of the lender, of the creditor. But the company that borrows will still collect from the customer. Once they've collected from the customer, then they will pay the creditor. Okay, that's how assigning works. On the other hand, factoring here means that the receivable will be sold at discount to a factor. This is why it's called factoring. Factor is actually a creditor or a lender. Okay, the factor is also the creditor or lender, and the collection is made by the factor. There's a difference between assigning and factoring. Assigning is not an outright sale of the receivable to the lender or the creditor. It is just assigned, meaning it becomes it is held as security by the creditor. It is not the property of the creditor yet. It is not sold, but they hold that as security. Okay, in the event that the borrower is unable to pay, then they can use the receivables to recover the payment. But factoring here means outright sale of the receivables to the creditor, and the creditor will then collect from the customer of the company. The company has no recourse or cannot collect the payment from the customers. That is called factoring. Okay. Then another type of secured loan is called purchase order or PO. Purchase order financing is a popular form of factoring used by small or medium-sized companies. Okay, when they receive a purchase order from a customer, they can use that. They can sell it to a lender, factor to a lender. So once the sale is made, meaning once the purchase order is made, the company makes the sale, the borrower makes the sale to the customer. Now the customer will then pay the factor or the creditor rather than the company, because the financing is already obtained by the borrower. The company will get the money first from the creditor. Therefore, when the customer makes the payment will go to the lender or the creditor. That is purchase order financing. And inventory loans is where the inventory becomes the collateral. So there are three types of inventory loans. One is blanket inventory lien. So this provides legal claim to the lender over all of the company's inventory. That is why it's called blanket, because it covers all. Okay, all. The keyword all. Therefore, it's called blanket inventory lien. So the lender will have legal claim over all of the company's inventory under this kind of inventory loan. Then there is this loan called trust receipt. Here the company holds specific investments in trust for the lender. So it means some inventories, let's say these inventories must be large inventories like automobile, cars, or aircrafts. Aircraft producers, the company, if they want the loan, what they do is they can use trust receipt, inventory loan. They obtain inventory loan through trust receipt. They provide the inventory as to be held as trust, in trust by the lender or the creditor. Okay, so once the company sells the inventory, the proceeds of the sale of the inventory will go towards paying the lender or the creditor. Okay, that's called trust receipt. And And then field warehouse financing is where a warehouse company, a third entity, acts as an agent to manage the inventory